Good morning. It's Tuesday, the 26th of September here in London. This is the Bloomberg Daybreak Europe podcast. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, China's property crisis deepens as defaults pile up and Evergrande's former CEO is detained.
The CEOs of Goldman Sachs and JPMorgan both warn of the impact of higher interest rates.
And we take a closer look at private equity's warning signs, where some buyout firms are borrowing at rates as high as 19%.
Let's start with a roundup of our top stories.
The troubled Chinese property developer Evergrande says its mainland unit has defaulted on a 4 billion yuan or $547 million onshore bond. The default comes as reports emerge that a former CEO and CFO at the company have been detained by Chinese authorities. Bloomberg's loans and bonds reporter Loretta Chen has the details.
The local media Caixin, which is a reputable media in mainland China, reported last night that the ex-CFO and CEO of Evergrande Group were detained by police. And these are the people who used to be right-hand man of Hui Kao-yan, the founder of Evergrande. So this is quite significant in terms of the destiny of this company. You know, whether it's going to finish all these unfinished projects while its chief executives are detained.
Loretta Chen says the detentions add yet another layer of uncertainty to Evergrande's restructuring plan with creditors. The news comes after a Bloomberg intelligence gauge of Chinese developers dropped by the most since 2022 as concerns over the sector grow.
Now, the EU's chief trade negotiator says that Beijing's failure to condemn Russia's war in Ukraine was damaging China's investment opportunities. Wrapping up a high-stakes trip to the world's second-largest economy, Valdis Dombrovskis issued this clear attack on President Xi Jinping's foreign policy.
China's position is affecting the country's image, not only with European consumers, but also with businesses. Over a third of EU companies in this country have indicated that China's position on the war is making it a less attractive investment destination. China's response and its contribution to resolving the war is a way that is important for us to engage.
Valdis Dombrovskis' trip to China comes as the EU announced a probe into China's electric car subsidies. The move has increased tensions between Brussels and Beijing, with the most significant risk being a damaging trade war.
The CEOs of two of Wall Street's biggest banks have been weighing in on growth and rates. Goldman Sachs boss David Solomon says he expects the Fed to hike further and the US economy to cool. Here's what he told the American Energy Security Summit.
I think it's going to be hard to get inflation back to the target, and that probably means if inflation is sticky, we will see additional interest rate increases, and ultimately that probably does lead to a little bit more of a slowdown in the economy. Whether that's a recession or it's just a slowdown, it's hard to say, but it would be unprecedented to go through this type of a tightening cycle and not see us get to a little bit of slower economic growth than what we're seeing right now.
The comments from Solomon come as JPMorgan CEO Jamie Dimon also sounded a warning on higher rates, saying, quote, "I'm not sure the world is prepared for 7%. Speaking to the Times of India, Dimon said that going to that level would be much more painful than getting to 5%.
The London Stock Exchange CEO Julia Hoggett says that UK firms risk their market value by listing in America. The LSE boss told a conference that international companies underperform US domestic companies in their stock market. She noted that out of 23 British firms that have raised over $100 million in the US over the past decade, 6 have delisted, 13 are trading down, and only 4 are trading above their initial value.
Nissan says it's still committed to making only electric vehicles by 2030, despite Rishi Sunak's green rollback. Bloomberg's Ewan Potts reports.
The boss of the UK's biggest car factory says there's no turning back now. The words of Nissan's CEO, who says he's sticking with the company's plan to produce only electric vehicles in Europe by 2030. Last week, Prime Minister Rishi Sunak pushed back plans for a UK ban on the sale of new petrol and diesel cars by 5 years to 2035. Nissan's also said it could make more vehicles at its massive Sunderland plant if the UK signs better trade deals to export them. Officials from the EU and UK, meanwhile, are expected to meet today to discuss their EU tariff regime. In London, I'm Ewan Potts, Bloomberg Radio.
Now, when it comes to Rishi Sunak, he is also under pressure to say whether HS2 will go ahead in full. It's understood that the Prime Minister is concerned by the cost of the rail project, but he has not confirmed reports that the Birmingham to Manchester section will be scrapped. The former chairman of HS2 until 2021, Alan Cook, has told Bloomberg's UK Politics podcast the government is ignoring the long-term benefits of the plan.
There has to be a much more consistent and concerted view from government about the long-term programs. If we constantly move away from one position to another position, it damages our reputation. It damages the way that we actually look at things. And actually, when we're trying to recruit the very, very best people that we need in the program, it makes them very concerned.
Alan Cook is currently chairman of the high-value manufacturing Catapult. The FT reports that the new US owners of Birmingham City Football Club have written to the Prime Minister with a similar warning that he will damage trust in the UK if he scraps the HS2 rail project.
Citadel founder Ken Griffin is said to have joined a group of investors led by fellow hedge fund manager Paul Marshall in a bid to take over the UK's Telegraph Group. Marshall, co-founder of the London-based hedge fund Marshall Wace, is lining up backers as he prepares for the auction expected in the coming weeks. Bloomberg understands that Griffin would only invest in such an effort personally and not through his company. Now, our food editor, Kate Crader, has the list that you need to read if you're planning to eat out in London this autumn. She's got her top 13 new London restaurants, so the openings that you have to get to. Interestingly, I suppose when Kate lays it out in the piece, but I kind of hadn't realised that this is the time of the year, which is where everything ramps up essentially for the food industry, because everyone's come back to, back from their summer holidays essentially. Among those that I was very interested in was the Wolseley's opening up a new dining room in the city on King William Street, only around the corner.
Yeah, very excited about that.
We'll book in there when that opens up. But interestingly, there's a Japanese theme running through some of the really hot openings as well. Kate talks about there's the sushi master Masayoshi Takayama, who's opening his first UK restaurant in Harrods. They've renovated the food halls in Harrods. Oh my goodness, who doesn't love eating in Harrods? Paper Moon, London in Westminster, that's another one it might be worth a visit. I mean, Kate Crader, who has literally the best job in the entire building. I bump into her sometimes in the Bloomberg coffee area, and she always has a marvellous tale to tell. Like she's trained as a chef actually herself. Oh, okay. I always feel that everyone stops her to ask her advice for where they should eat out this weekend. Of course. Slightly tortured by her colleagues. Anyway, that's a great piece to read if you get a chance from Kate Crader about the 13 new restaurants in London to eat in this autumn. OK, now let's turn our attention then to the crisis at China Evergrande Group. It deepened on Monday after the company's mainland unit said that it failed to repay an onshore bond. The poster child for China's property woes scrapped key creditor meetings at the last minute too. Let's discuss now with China credit editor Kevin Kingsbury. Kevin, thank you for joining us. How did the defaults come about, firstly?
Well, this is the second time, actually, that Evergrande, its Hengda unit, has defaulted on this particular bond. 6 months ago, it had an interest payment, and it didn't pay it then, said it was working with bondholders. And the bond, 4 billion yuan, it was puttable on Monday. That means it was the creditors had the ability to demand early repayment. The bond wasn't actually due until 2025, but they putted the bond, and Evergrande said that it couldn't pay both the principal and the interest on this bond. So it's the second time, but it's also only the second onshore bond that Evergrande has defaulted on. We've talked so much in the past 2 years about the offshore debt, but it has been keeping kind of current with its onshore debts. It's also been able to extend a number of different bonds there. So this is kind of another sign as to just how bad things are getting with Evergrande. They talked about, obviously, these falling sales in Friday night's filing that in which they said that the creditor votes for the offshore debt restructuring was going to be scrapped. So it's just one more thing after another as far as Evergrande recently.
This, of course, as the company is trying to work out its massive restructuring plan as well. What are the next deadlines the company's facing?
Well, we're looking right now at October 30. That's the next hearing for what is called a winding up petition. It's where creditors here in Hong Kong, they can seek court liquidation of assets from the creditor if there's any concern that they're not able to get repayment or that there's some sort of repayment controversy about the bond. So in this case, it's an investor who bought into a onshore car platform of Evergrande several years ago. Because it didn't go public, there's been some back and forth as to whether or not the investor is able to get its investment back. And so that's why it filed this court hearing back in the middle of 2022. So this has been going on for more than a year now. And the judge in the case, who has issued winding up orders against 3 other builders here in Hong Kong, it hasn't been very good as far as being able to let creditors continue to let things go. So she may be pretty apt at this point to say, you know what, I might be inclined to issue an order in favor of the plaintiff in this case come October 30. So we'll just have to wait and see.
Okay. Contagion risk. That is also clearly what has worried many over the last couple of years. Could China's deepening property crisis flare up sort of more significantly now?
I think so. I mean, we'll, I think, get a better understanding both with the September new home sales data that should come out at the end of the week from China Real Estate Investment Corp. It's a pretty closely watched firm that issues monthly estimates at the end of each month. And then also we have the Golden Week holiday next week on the mainland, which is long time a key new home buying period. And so if people are still concerned as to the health of developers, whether if they were to buy homes now, whether they would ultimately get delivered to them, we might see folks continue to wait on the sidelines. Mortgage rates are definitely lower than they have been, but that still so far doesn't seem to be able to get folks into the market and to signing contracts.
Kevin, another element to this story as well has been the detentions, according to Kaishin, of the former CEO and CFO of Evergrande. What do we know about that at this stage? Yeah,
it seems as though China is moving into more of a little bit of a criminal aspect regarding Evergrande, not just these 2 executives, which both left the company in mid-2022 after roughly $2 billion worth of security deposits were used to help guarantee some other loans. So that ultimately led to their sacking middle of last year. But we're just trying to see where exactly this goes. We had some of the staff of the Evergrande Wealth Unit detained within the past several weeks. So it does seem as though the government is moving in a little bit of a different direction, at least as far as Evergrande goes, into looking at some potential criminality.
Okay, Kevin, thank you so much for being with us and for updating us. That is Bloomberg's China credit editor, Kevin Kingsbury.
Let's turn to a story next around private equity. Firms have been borrowing more debt in this space. This time they're layering on debt to their own management companies, raising concern among some investors about potential risks to the wider industry and the financial system. Our reporter Laura Benitez has been looking into this and she joins us now in studio. Morning to you, Laura. Why are private equity firms borrowing more and what do funds investors make of it?
Well, deal making's been down year on year, and along with fundraising, it's been really, really challenging. So private equity firms, in short, are having to be much more creative with how they raise cash and how they shore up more liquidity. In terms of how investors are feeling about it, I think there was a real stigma around it a few years ago, but it has become more accepted, and especially while conditions are very challenging, I think there's an idea there from investors that if it helps returns, then it could be beneficial. But there's still a lot of caution and wariness around it.
Yeah, what sort of loans are they borrowing and is it becoming a bigger risk?
So there's 2 types of loans that we're talking about in this story. One is a loan called NAV, which we've written quite a bit about, and that is financing at the fund level. Now, what we've written about in this story that we've tried to highlight is the increase in demand for something called a management company loan, which sits at the management company, obviously. But the interesting thing there is that the collateral for that debt is things like, fund fees, management fees, performance fees. So, in essence, it can be the fund manager's salary in a sense. That's what's made it so interesting.
One of the fascinating parts of the story is the interest rates that is being paid on these loans as well.
Exactly, and that's something that really caught our attention when we first started reporting, was that the interest rates for these types of loans can go up to 19%. Now, there is a big range, and it's depending on the risk profile of the private equity firm, but those numbers are very eye-watering, so it does make you more aware, and it does prompt a lot of questions around the risk and the extra leverage that's in the system now.
Yeah, who is benefiting from this? Who's at risk of not being paid? Who are the lenders involved?
It's a really interesting question because because at the minute it's a very lucrative market for the lenders because obviously the returns are very, very juicy. At the same time, they're the ones at risk because these loans are very hard to default on. If you try and kind of claim back the collateral, it's things like management fees, like we mentioned earlier. So that's quite hard to claw back. So there's two kind of sides to this. Like, it's a very lucrative market for these lenders, but they're also putting themselves at risk.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.